a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Small cap biotech ETFs have been doing quite well so far this year. We're going to find out exactly why from our ETF research director, Nina Mishra, who joins me here right now. So you describe these ETFs as soaring.
Yes.
Why exactly have they been soaring?
So this year started with very healthy, very strong M&A activity in the healthcare space. And the main reason for that is the tax reform. Many large pharma and biotech companies, which had a lot of cash parked overseas, are now able to access those billions of dollars in cash and use that for M&A activities, among others. And lower tax rates are also helping these companies. So these cash-rich companies are willing to acquire smaller, very innovative biotech companies, even at a hefty premiums, as we have seen in some recent cases, because they want to build their pipelines. And of late, FDA has also been approving many innovative drugs and therapies. But at the same time, investors should remember that biotech is a risky space, and further, smaller biotech companies are more volatile than their large cap counterparts. And two of these ETFs hold a lot of companies which are in clinical stage, clinical trial stages. Their products are in clinical trials.
Right.
So in that case, the chances of failure could be high.
Things haven't been proven yet.
Yes. So those companies are even more riskier. So these investments should be treated as high growth potential, but high risk investments.
Okay, all points well taken. You've brought three examples of such ETFs with you. First one being the PowerShares S&P Small Cap Healthcare Portfolio.
Yes, so the ticker is PSCH, and as the name suggests, it holds small cap companies in the healthcare space, 78 holdings as of now, which are market cap weighted. Expense ratio is very reasonable at 29 basis points. It's up about 18% year to date. And if you want to learn more about the ETF, you can go to the code page, and through the link for external home page, you can go to the sponsors website, and you will see that healthcare equipment and suppliers, they account for about 1/3 of the portfolio, and healthcare providers and services also provide for about a little less than 1/3, and biotech and pharma are third and fourth in terms of sector allocation. And you can look at the holdings over here and other details. As you can see that mid-cap and mostly small cap companies dominate this ETF.
Okay, then there's Lancar, I hope I pronounced that right,
Yes.
Lancar Cancer Immunotherapy ETF?
So the ticker is CNCR.
Yeah.
That's an interesting ticker.
And, yeah.
And as the name and the ticker suggests, this ETF holds biotech companies which are focused on immunotherapy research. It has 30 holdings which are equally weighted. Expense ratio again is a bit high here, but it's up about 13% year to date. And you can look at, if you want to learn more about this ETF, you can go to the code page on Zacks.com, read all the articles, and also go to the sponsors page from the link. And you can see this ETF, as I mentioned, has 30 holdings, of which 5 are large cap immunotherapy leaders, large biotech companies, and 25 companies are clinical stage biotech companies. You can look at the holdings over here, and that would help investors. And as I mentioned, this ETF is up about 13% year to date.
All right, and then finally, the Virtus LifeSci Biotech Clinical Trials ETF.
So the ticker is BBC, and as the name suggests, it holds select clinical trial stage biotech companies. So these are mostly younger, smaller companies. They don't have a product which has been approved yet on the market yet, but their products are going through clinical trial stages. They have the potential to be acquired by bigger biotech companies and pharma companies. It's a diversified ETF with 85 holdings which are equally weighted. So as I mentioned, these companies are riskier, but having them in the ETF form reduces single company risk with so many 85 holdings which are equally weighted. This also has an expense ratio of 79 basis points. It's up more than 12% year to date. And if you go to the sponsors website, you can learn more details about this ETF. It mentioned this is high growth potential. These are high growth potential companies, and equal weighting reduces single company exposure to a large extent. You can look at the holdings also over here, and as you can see, we don't see many familiar companies because these are smaller, rather unknown, younger companies.
Okay, so we're not going to compare them to anything this time around, but do you own any of these?
I don't.
All right, you can always check out more ETF information, and you know where that's at if you've been watching these segments with any regularity. It's on Zacks.com, so all you need to do is get to the home page, use the Funds tab in the top toolbar, and it will help guide you right to that section. With Nina, I'm Terry Ruffalo.